Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Friday, January 6th, and then we'll see how things look for Monday, January 9th. We had a pretty solid update. All of the indexes had pretty major gains, but now we have to ask ourselves, are we starting something new, or are we just bumping ourselves up a little bit in this trading range that we've been in for a while? And right now, you can make a case for either side. And I have a number of charts to show you, so we'll go through and look at those and try to evaluate where we're at. So right at the open in Friday's session, we did have a higher open. The market really liked the employment situation report, and that seemed to be very favorable. So we hit resistance at 38.50. That's one of the upper ends of this trading range that we've been in. And then we ended up declining below the daily pivot at 38.17. Not very surprising to see this happen. We had a gap higher, prices fall back down, they fill the gap, and then we ended up hitting support at 38.09, just about at that 3800 level. Well, things then really started to improve. Prices moved sharply higher. They went above R1 at 38.31, as well as R2 at 38.54. As the day continued on, prices kept advancing. We got above that 38.75 level. We actually made it above R3, which is usually not written on the chart that I show you, but I added that to the intraday chart. That was at 38.91. We even got a little bit above 3900 before the close, and we ended up closing just below 3900 at 38.95. We ended up being up 2.28% on the day. And volume picked up as well. It was actually above average. So our technicals, a little bit mixed right now. Things are turning more positive. We still have probably more negative than there is positive, but to have over a 2.25% advance, you can't help but see some of the charts improve. And this is all being led by the inflation and interest rate scenario, which is also feeding into what the Fed is or isn't doing, because now the market has adopted a new scenario. But before I talk about that, here is the intraday chart showing how we gapped up higher above R1. We then came down below the daily pivot, almost came down to the unchanged level, and that's very common. We filled this gap. Well, then the market decided that it wanted to go higher, and off we went. We went back up above R1. We stalled a little bit at R2, but we're able to break above that. Here's the 38.75 level. We stalled along that for a while. Then as the day kept going, we went higher and higher up above R3. We broke above 3900 before falling back below it going into the close. So it was a pretty positive day, but is this really going to change anything? So some of the comments that we can make are, and I've kind of facetiously put this here, pivot scenario 8.0. For over a year now, the market's been trying to develop this scenario that the Fed is going to ease, that inflation is calming down, and that the Fed will either pause their interest rates hikes or maybe even start to lower them at some point. And Friday was no exception. We're picking up right where we left off. Now, some of you are probably pretty gun shy of this. This is the sixth, seventh, eighth time or so in the last year that the market has tried to develop this scenario without getting any real hard evidence from the Fed, but yet it's using that anyway, and it's sucking a lot of people in thinking, oh, well, here we go, we're going higher. Well, we need to be really cautious with this, because now the scenario is that the Fed may be able to pause their rate hikes sooner than previously thought. That was developed after the employment report came out on Friday. The markets really liked this report, the employment report, which showed wage inflation moderating to 4.6% on a year-over-year basis, where it had been 4.8%. So it's coming down, and this is a large part of what the Fed is using to justify interest rates, that the employment situation is really solid right now. People are doing really good, and they're making more money because the job market is pretty tight. Well, they've been having to raise what they're paying people. Well, if this starts to go down, maybe that shows that the employment situation is starting to weaken. We also had the ISM non-manufacturing index. It dropped below 50, and that shows contraction. This also fed into this scenario that maybe the economy is getting a little weaker and the Fed won't be as aggressive as they have been. Another thing to be aware of on the negative side, though, is growth is still underperforming value. Growth was up on Friday, and that's where you get the really monster moves in the indexes that are sustained over a period of time. But value is still really outperforming growth. And even in Friday's session, in the large caps, growth still underperformed. Then also, I'll probably take this off after this particular video. China is going to end their really strict quarantine requirements for international travelers starting on Sunday, January 8th. And there's a lot of people within China that are starting to travel a lot more. And so that's just helping to loosen a lot of those restrictions. The VIX is still acting kind of strange, not as weird on Friday, but we're still watching what had developed into a weird situation, and we're going to keep an eye on that. So I have a chart to show you. And the concern is the earnings per share for the individual companies as well as for the indexes. That's producing a lot of valuation concerns that maybe the market is overvalued. The prices that we're at right now are too high when you compare them to what companies are earning. And so prices need to come down to justify the current valuation levels. The dollar was up in Friday's session. Actually, that's incorrect. It was actually down, and that gave a lot of support. I forgot to change that. What I did change is that interest rates were really down as well. So you had the dollar falling, even though there's an error on the slide here, and interest rates going down. That gave a lot of support to stocks. Then, believe it or not, because we've been in this range, if we get a big move up or down, it gets us into extreme positive or negative territory pretty quickly. Well, with the upward movement that we saw on a short-term basis, we're giving some extreme positive or overbought signals right now. Our stochastics chart, our Stoch RSI, and our Williams percent are. And I have those three charts to show you. Then on an intermediate term basis, and this is more short to intermediate term, the CCI based on 14 periods, it's also extreme positive right now. We still have all of our yield curves that are inverted. That's suggesting going forward or looking out into the future that there will be economic problems, because this is not normal for the yield curves to be inverted. Sentiment is back to neutral. We had been in the fear area. Well, with the upward movement on Friday, we drifted over into the neutral camp. The employment situation report, I'll go over on the next slide. We also had the ISM non-manufacturing index. That came in at 49.6%. They expected it to come in at 55. So this was quite a bit weaker than they expected. The last time we had this report, it was at 56.5. And also note that we're below 50. So that's showing a contraction in the economy with the non-manufacturing part of the economy. Factory orders also decreased 1.8% on a month-over-month basis, a lot more than the down 0.4% that they had expected. The last time we had this, it was up 0.4%. When you calculate shipments of manufactured goods, they were down 0.6% on a month-over-month basis. And the last time we had this report, it was actually up 0.2%. And I apologize if you hear some talking in the background. The trend, believe it or not, our ADX has actually switched over positive. The green line has crossed over the red line. They're not very far apart. And because of this change that we just had, the ADX still continues to weaken because those two lines are pretty close to each other. We're still well below 20. And I've changed our bias over to mixed to positive. Now, I could go full-blown positive with this because of the strong up day, but go through some of the charts and it's like, has anything really changed all that much, at least yet? My opinion is we're going to need to see more follow-through before we get back to a more positive environment. And then our momentum I'm keeping right now as mixed, because we could just as easily have a down day on Monday as an up day. Follow-through is going to be the key. All right, let's go back and talk about the employment situation report. The headline number that the markets look at and that the financial media likes to report, there was an increase of jobs of 223,000, more than the 210,000 jobs. The last time we had this, it was 256,000. So it was greater than expected, but not as strong as last time. Because it came in stronger than expected, the market could have just tanked on this news and used that to justify what it was going to do, but it didn't. Also, non-farm private payrolls, they were up 220,000, 20,000 more than they were expected. And we also saw an increase because last time it was up 202,000. The markets could have tanked on this news too. The unemployment rate, it fell to 3.5%. It had been at 3.7. They adjusted it down to 3.6%. The market could have tanked on this news because all of these right now are stronger than what the market expected. And with stronger than expected reports coming out, that gives rise to the Fed coming in and justifying raising interest rates. This was the big one. Average hourly earnings, they rose 0.3%. Okay, they were up, but not as much as expected. They expected it to be up 0.4%. The last time we got this report, it was up 0.4%. This is what the market fixated on right here. This came in weaker than expected, and everybody got happy. Interest rates started going down, stocks started going up, the dollar started going down, and we were off to the races as far as the market is concerned. A day after we get out of this period of time known as the Santa Claus rally. Isn't that interesting? Then the average work week, it fell to 34.3 hours. The last time we had this, it was at 34.4 hours. So we saw a little bit of weakness under the hood with the employment situation report, but the surface numbers are still quite strong. Here's a chart that I have been showing where the white line is what we're really paying attention to right now. This is just the decrease in the earnings per share. And the kind of orange line here, that's the profit margin. That's what's going down. And this is what's providing a really solid headwind for stocks to go higher. This is also a chart that I showed in yesterday's video. These are the assets of all the major central banks, the Fed, the European Central Bank, and the Bank of Japan. And this blue line is that their assets are going up. Well, near the end of 2021 and into 2022, we're seeing this line coming down. And isn't it interesting that the stock market has been running into trouble with that as well? This is a big macro indicator that we use because when there's a lot of money going on the balance sheet of these different central banks, a lot of that finds its way into the stock market. And that money is used to then buy stocks, which when you do this in huge volume, that really pushes prices higher. Here's the chart also that we've been kind of following along with the 2006 through 2008 price movement, where way over on the right-hand side, the white line is what the S&P has been doing. And this chart hasn't been updated for about a week, but we're right at about the same level right now, a little bit below this 4,000 level. The yellow line is what happened in 2006 through 2008. And are we going to stick with the same basic pattern that's been happening? Up until Friday, it was really likely that we were sticking with this. But even this yellow line, see where it gyrated around? It didn't just go straight down. But overall, it did decline. And are we going to pick up with this white line and continue to go down with this, which would suggest that we will see weakness going forward in the S&P? The VIX to the S&P 500 correlation, it's starting to spike right here, and it's coming down just a little bit. And if you look down below where these red lines are drawn, these are other times when this correlation really spiked. And often what will happen is this will produce short to intermediate term weakness in the S&P 500. So that's another thing to be aware of. The Ulcer Index is starting to decline. When we're above this red line, which is a moving average, that means there's more fear. When we drop down below this, that means that we're actually more positive. So this indicator is a little more optimistic than the neutral reading that we're getting right now. We would want to be right around this red line for it to register a neutral reading, but it just shows that a lot of the fear, according to this indicator, is coming out and it's being replaced by greed or a more positive stance on the market. Here's the equity put call ratio, the one-day chart, where we just really spiked up here. We came down. Well, it actually advanced on an up day. That's one of the strange things that we're seeing right now. And if you see up in the price area of this chart where we've just been chopping sideways, and we're really right back to the top part of this range right now. We haven't really broken out. We haven't really broken down. If we see some weakness in Monday or Tuesday's action, we could take us right back down into this range that we've been in for quite a while. Here's the 5 period where we spiked with the 5 period moving average, and then we've been really coming down. But as I keep pointing out on this chart is when we get a big spike like this, that usually marks some kind of climactic downward price movement with the S&P. Well, we've just been going sideways. So we want to be really leery of using this as a signal because we've been chopping sideways when we spiked. Now, that could still turn around and continue to go up higher, but it's not what we normally see when we're using this indicator. And this is a longer term look at that same spike going really high and then coming back down. And even though it is declining, we're still at a very high level with the equity put call ratio. Here's our trend with the ADX showing that the lines had just crossed. We were defaulting to the red line, which is negative. Well, when they cross, now we're defaulting to the green line, which is positive. And since these lines are so close together, the ADX is continuing to decline and it's below the moving average. So this would suggest a more trendless environment, but it is now defaulting to the positive side. Looking at our one-day rate of change from Thursday to Friday, we probably overdid it with how far the S&P rose just in one session. We're looking a little bit extreme that way. So Monday, you might see things slow down a bit. We also see it with the advanced decline ratio. We saw a lot of buying going into stocks on Friday. And so we had one of these real big up thrust days. But we've seen these before, only to have the market fizzle out after that. Is this finally going to lead to something? Here's the Stochc RSI. This is a really touchy indicator where just a few days ago we were extreme negative. Well, with the upward movement in Friday's session, now we're extreme positive. And the same thing with the Williams percent R. It had been extreme negative just a couple of days ago. Now it is looking more extreme positive. That's why I use these as short-term indicators. The CCI 14, which also is a little more short-term, it's looking pretty extreme. Where the CCI 20, which is the same chart only based on 20 periods, it's more in the middle right now. This is kind of a biggie too. Our parabolic SAR system, stop and reverse, when the dots are on top, that's negative. And that's what we've been seeing as we were chopping sideways. After Friday's session, we finally got a dot underneath, which is positive. So that's kind of critical. We'll have to see, can price follow through and continue to go up from here? I wanted to show you all of our oscillators where the slope, this is the one I've been bringing up in the daily videos. It's positive and has already crossed over. Where the MACD, the KST, the TRIX, the PMO, the TSI, these are a bunch of different oscillators that I look at. The TSI is starting to cross over positive, but these other indicators, they're showing improvement, but they have not crossed over positive yet. The PMO, another oscillator that's actually back on this page too. It's down here second from the bottom. We do a more in-depth study of the PMO, the price momentum oscillator. Overall, it's still negative, but starting to turn up. What's interesting is when we calculate this based on price, it's starting to cross above the moving average. And even a day or two before that, based on volume, this started to cross above positive. And sometimes this is a leading indicator. So this could suggest that things might continue to improve. The BPI, still below 50, so it's negative, but it saw a little bit of a tick up in Friday's session. So it's just looking a little bit better, but we want to see this continue to go up and get above 50 for it to turn even more positive. Another short-term look is our short-term stochastics, where we're looking extreme positive. Again, just a few days ago, we were extreme negative. With the intermediate term, short-term stochastic, we're just getting above the midpoint, which is the line between positive and negative. And the long-term, short-term stochastic is starting to turn up after giving us an extreme negative reading. So they're showing a lot of improvement here, but we're going to have to see follow through, but we're still in a trendless environment. Here's our daily chart showing how we came right up to the pivot. Isn't that interesting? That provided the overhead resistance. Also, the 50-period moving average provided overhead resistance, and then we fell back down slightly below that. Looking down at the bottom, you can see where volume was slightly above the average for volume. The Swinland trading oscillator, which may have been giving us a couple of days advance on this, because sometimes this is a good leading indicator, but there's been other times when it leads us astray as well. Well, based on price, we saw an advance, and based on volume, we're seeing a nice advance. Here's the moving average tree where we're starting to come back up into these moving averages. And this gold line here is the 100-period moving average. We're also bumping into the 50-period moving average, and it's just kind of a tangled spaghetti mess right now. We're going to have to really break through and see if we can deal with these 200-day moving averages, or are these going to provide enough resistance where we're going to fall back down. The summation index based on price is turning back up higher. And again, based on volume, this did give us a couple of days warning. We're going to have to see if it's still valid or not, because sometimes this can turn up and price might turn up for a day or two, but then it doesn't stay turned up. New highs, new lows. With the up day, we saw a bit of an advance with the new highs and a contraction with the new lows. So our 5-period is showing improvement, and our 10-period differential is starting to turn back up. So there's some improvement going on here. We just need to see more follow through. Our Elder Impulse chart, and this is on the SPY, which is the ETF of the S&P 500. It changed back to a green bar from a blue neutral bar. And the same thing would be true with the S&P chart. These are pretty much identical to each other. Our fib levels, we're starting to get back above some of these resistance areas, but we have another resistance area above where we're at about the 3906 to 3907 area. That's this other red line in here, but support held up pretty well as we were chopping sideways. Now we'll see if we can break out. One of the positive things is the longer we have sideways movement, the more powerful the movement either up or down tends to be. Right now, are we going to have a breakout from this? It's kind of what we're asking. Our longer term fib chart, we're well above this double fib retracement level, and this held up fairly well also. And are we going to see a continuation of the breakout to the upside? Our weekly chart, we're still holding above this level of support. We're still above the 200-week moving average. So we're hanging in there and showing some improvement. Another thing that we could use as a positive signal is the Kopit curve. When it comes down and starts to go back up and then crosses above this red line, that sometimes will mark a really good buy signal for prices to go higher. And that's what we're seeing playing out right now. So this could be positive. But some of our other indicators are not showing that yet. Just the ones that are showing us something are what I'm telling you about in this video. Another thing that we could use is potentially something positive is the staples to S&P 500 ratio. The staples really spiked up and then they've been coming down. And so that's why I have to put a question mark here, because we really don't know until we kind of look back in time to go, oh yeah, that was a valid spike. When this spikes and starts coming down, you can see other times when that happened. And a lot of times that will mark some kind of a bottom in the S&P 500. Except way over here. Yeah, this marked a bottom in the S&P 500 as well. So we have some potential positive things. Now our sector rotation, that still looks like garbage. Some of our other positive setups, they're not really giving us anything right now. But these charts that I'm showing you are giving us some positive signals. The mid caps are still hanging in there. They broke above the daily pivot, and now it broke above both of the moving averages after giving us a recent golden cross. The Dow is also above this pivot level and above this range that it's been in. Can it stay above that after giving us a recent golden cross well before the mid caps did? Because the Dow is really what's been holding up the best if you go back to last fall. I wanted to also show you here that how interest rates were really down across the board. They had been really going up, but in the last week or so, we've been seeing a decline in interest rates. So our outlook for Monday, the technicals are negative, but they're turning more positive if we see follow through. That's why if you're a trend-based trader, if you're looking to get into something, hoping to buy low and sell high, personally, my rule is I wait as close to the close as possible, because we might have just a rip-roaring open on Monday and then see a counter trend move that fills that gap and then just keeps going. And here you are getting into a position that you hope is long, hoping that it will go up, only to have it go down. And now after one day, you're seeing a pretty significant loss. But that's the rule that I implement here. We have to see more follow through. We have consumer credit coming out on Monday, and that's it. And then the geopolitical events with inflation and interest rates being the real driving force of the stock market currently. So our scenarios can't really go with the down one right now because we're not trending, number one, and we're starting to look a little bit more positive. We can't go with the up scenario yet because, yes, things are improving, but most of our indicators are still negative. We need to get above some more of these moving averages. They're right now acting as resistance. Can we break above them to the point where they could act as support at some point? We're getting above some pivot levels. We're right at a pivot level with the S&P 500. We're staying above our fib retracement. So there's the potential of things really improving. But at the same time, you could say that we're just at the top end of this trading range and things could fall down just as easily. So we're still going with this sideways because the ADX is weakening. It's below 20 and it's just switched over now to positive with the green line on top. So until that really turns back up, it's hard to really justify that we're in a trending environment currently. So our conclusion, the S&P is negative, but it is improving. It's sure looking better, but we were looking better last week as well, only to have that fizzle out pretty quick. We need to see follow through. In the short term, we're negative, but a lot of our indicators are turning positive, with some of them even becoming extreme positive or short-term overbought. Intermediate term, we're still negative overall, but could be seeing some signs of improvement. Long term, we're still negative because we're below the 200-day simple moving average. Thank you. Have a wonderful weekend. I hope you found this helpful and informative, and I will talk to you in the next video.